Welcome, and now we are going to discuss the disclosures of the income tax expense and balances in terms of IAS 12. So just to start off, why do we calculate deferred tax? Why do we calculate current tax besides for tax authority purposes? Well, the whole point here, remember, for this course is to have a result, which will be the recognition and disclosures in the financial statements. So I'm giving you a suggested format here for disclosures and later on for calculations, etc., in order to get consistent results every time you do either an academic question or a real-life case study. Please note this is not the only format. There's different formats with different variations, etc., but all I'm asking is that you choose a format and you stick to it and make sure it gives you a consistent approach. Okay, so let's just kind of go into an overview of what the notes to the financial statements need to include when you're talking about income taxes. So first of all, there will be income tax expense, and here I'm talking about the profit or loss component. That's going to have two different disclosures. First of all, the major components of tax expense, which will be made up of current tax expense as well as deferred tax expense. Okay. Next up, you will need to look at the tax rate reconciliation. The point of this is to show your readers or users of your financial statements why your income tax expense is not necessarily at the standard rate of 28 or 30% of PBT. So here you're going to start off with your profit before tax, work out your standard rate on that PBT, let's call that 28%, and you need to work down and reconcile what the effective rate is actually at. Okay, and you'll see just now we'll do that, and there will be a whole bunch of permanent differences, capital gains, foreign income, etc., that will mess up your normal standard tax rate. I also need you to just think about the OCI components of items that are going through other comprehensive income. So again, on PPE, there will be a tax effect in terms of deferred tax, sometimes current tax as well. Last up, please note that there is also a balance sheet or financial position side to taxes. And there's going to be two sides here. There's going to be the deferred tax assets and liabilities as well as the current tax payable or receivable. Okay, so big picture, happy with. Let's now look at the more detailed disclosures. In the disclosure pack that's going to be downloadable off the learning site, I've given you a disclosure pack for income tax as well as all the workings for it. Okay, again, our suggested format, not the be all and end all. This is not 100% dictated by the standards. We are looking at the standard and try and take what their disclosure requirements are and put it into an easily usable format, okay, in order to give you a consistent approach. So let's start off with our disclosures for income tax. Okay, first of all, the income tax expense. Two components, as we said, made up of major components of income tax, and second of all, there will be a tax rate recon. Let's look at the major components here. The two major components of income tax expense are current tax expense and deferred tax expense, which if you go right down to the bottom will make up my total tax expense going through profit and loss. And please take note that may be a debit or a credit in total. Okay, and this line item must reconcile and be exactly the same as what is your tax expense, okay, in the statement of profit and loss. Must be the same figure. Okay, so starting off, let's have a look at my current tax expense first. So current tax expense is going to have multiple items. Okay, I've listed them all here, and we'll start addressing these as the lectures go on. First of all, let's have a look at our normal local current income tax expense. That will be per your tax computation, okay, which will equal your local income tax return. Okay, so here that's always going to be either a expense, a positive, or it's going to be nil. Okay, and again that comes from the tax comp. We also may have an under or over provision, okay, of prior year income tax. So in previous years you might have calculated your current tax comp differently to the amount that it is assessed at. When the tax authority gets your tax return, does an assessment, they come back with a different figure. Well, that is a change in estimate in terms of IAS 8, and therefore I need to make the change in the current year. Okay. There also may be foreign current income tax that will also be included under current tax expense. A couple of other items that could be listed there we're not going to discuss now. Now moving on, let's have a look at the deferred tax expense. Remember here, I'm looking at deferred tax expense, the movements, okay, not the balances. Starting off, the most standard one you will deal with right up front when you're dealing with the basics is my movements in temporary differences and the resulting deferred tax expense. Starting off, we're just going to discuss the normal rates. Okay, we will deal later on with deferred tax movements in temporary differences from capital gains, but that's a more complex matter for a future discussion. So normal rates, here we could have a debit deferred tax profit and loss being a positive, or the journal could have been a credit deferred tax profit and loss, which means it would be a negative to the expense item. Okay. Also later on we're going to deal with what happens when there's a change in tax rate. That's going to have an effect on deferred tax. Now that may be a debit or a credit to profit and loss, increase or decrease the deferred tax expense. Then as a big category, we also need to disclose line items about the tax losses carried forward or utilized. Okay, the most common one here will be my assessed loss for normal income tax, and here you will deal with assessed loss brought forward from prior year as well as assessed loss in the current year carried forward. Remember, tax legislation for companies, not individuals, when you run at a big loss, the tax authority does not say, well, here's a check, sorry you made a loss, here's some money back. Okay, what do? The tax authority says take that loss from the current year and utilize it in future periods to reduce future taxable income. Okay, again, a future lecture, not going to be discussed now, but I need you to know that there will be assessed loss disclosures. Okay, for normal income tax as well as for capital gains. If there are capital losses, they can be carried forward, they are ring-fenced and only can be offset against future capital gains. Therefore I must have separate disclosures again for capital losses prior year brought forward and current year carried forward. You'll see there's a couple of line items in between the assessed losses brought forward and carried forward. It's all got to do with assessed losses that are not recognized because they don't meet the definition conceptually of an asset. Okay, again, we will deal with that in future periods. This is a complete list with all the complex items included. I need you to learn this off by heart as a starting point, and then as we go forward with lectures you will start understanding step by step. But sometimes in accounting the best place to start is learn what needs to go down in the disclosures. Okay, so that you always have the bigger picture in the back of your head. Okay, and as with current, there may also be foreign deferred tax, and that would need to come in here as well. Okay, so I would take all my deferred taxes, I would need to sum them all up, okay, and put it in to the total. And either I would have a increase in the tax expense or a decrease, a credit to profit and loss. Next step is to add up the current tax expense, add the deferred tax expense, and that will give me my total tax expense or tax income for the year that will go into the statements of profit and loss and other comprehensive income. Great. Please take note of this, learn it, you're going to need to use it. The second part of my income tax expense disclosure is my tax rate reconciliation. Okay. Now the tax rate reconciliation reconciles the actual standard rate, let's say that is 20%, okay, as compared to what the effective tax rate is in your financial statements. Effective tax rate, you can always check by taking the tax expense line item, okay, in total, which was made up of current and deferred, and divided by my accounting profit before tax. It is very unlikely that that is going to equal 28%, because we have some reconciling items, items that will either result in non-taxable income, okay, or non-deductible expenses, or items of income and expenses that will be taxed at a different tax rate, such as items of capital gains tax. Okay, so let's have a look at a basic reconciliation that includes the majority of the stuff here. Again, 80-20% rule here. Okay, we can only fit 80% of the content into these formats because there's always going to be transactions that will develop that we cannot fit in here because they maybe don't exist yet. Okay, so starting point, please, profit before tax, your accounting figure from your statement of profit and loss and OCI. Put it in there, and I want a double line underneath it, please. Okay, that's your starting point. You will then take that and work out the tax thereon at the normal tax rate. Let's assume that that is 28%. Okay. Then I need you to reverse out the effects of all permanent differences. The best place to kind of pick this up is from your current tax comp. Okay, where you've reversed these items out as you would in your tax return. But remember, those items are all going to be before multiplying by tax, so times it by the tax rate, because here I'm dealing with tax expense. Okay, so let's have a look at a few little permanent differences. Okay, you don't have to split them up between non-taxable and non-deductible. You can group them all together, but I prefer to do it like this. So some non-taxable income. In most legislations, dividend income is non-taxable. I'm not saying there's no tax ever on dividend income. What I'm saying is it's not part of my normal current income tax. There's either a separate dividends tax, such as secondary tax on companies, okay, or a dividends withholding tax, etc. That is a different discussion altogether. Here, current income tax only. Okay, so dividend income was an income in my profit before tax figure. So, in order to reverse it out, I will need to subtract it. Remember, I'm dealing with the tax expense here, so the amount per the current tax comp times by the tax rate, reverse it out. Some non-deductible expenses that need to be added back. If donations aren't tax deductible, then I need to add them back. If fines aren't tax deductible, I need to add them back. Reverse out the accounting effect in the profit before tax. Next up, I want you to look at any items, okay, that had capital gains tax effects on. The best way to look at this is don't try and net it off, because capital gains is actually going to get very tricky later on. What I want you to do is take your normal capital gains at the normal rate and reverse it out 100%. Okay? So total taxable or capital gains times by the tax rates at normal tax rates, reverse it out, and then per your CGT calcs, etc., there will be tax provided on capital gains. Okay, and that is what you will then take into account. So all I'm really after is the net between tax at normal rates on capital gains versus the actual tax provided. Okay, generally that will be a decrease in the income tax expense. Then if there is a change in tax rate, that will give rise to a change in estimates in the current year, and I need to show the tax effect on the tax rate recon. Here I might have an increase in the tax expense or a decrease depending on what the journal for that tax rate change looked like. Similar thinking for under or over provision. If I had under or over provided for tax in the previous years, okay, well then it's a change in estimate in the current year. So what do I need to do? I will have a increase. If I under provided in previous years, I'll have to increase the tax expense this year. If it was a over provision in previous years, I will change the estimate in the current year in terms of IAS 8. Next one, I also want you to think about any foreign income. Why would this change my tax rate and cause a reconciling item? Well, take your foreign income, times it by the South African rate, reverse that out. Okay? If the foreign tax rate is greater. Okay. Take into account the foreign tax, and you will see again that there may be a difference between the two. If there's a difference between the two, that will be a reconciling item, because I'm reconciling profit before tax times by the local income tax rate, okay, as compared to my actual total tax expense recorded. One of the things that will cause this reconciliation is foreign income that is taxed at a different rate. Take into account that effect, please. Okay, and then the last thing is any deferred tax assets, generally from unutilized tax losses being carried forward, have to be tested for whether or not they meet the recognition criteria of an asset. Okay? Sometimes they do not, and we will deal with that conceptually later, but whenever a deferred tax asset is unrecognized or not recognized, okay, whether it be a normal temporary difference deferred tax asset or an unutilized tax loss, okay, well, the unrecognized portion will cause a tax rate reconciling item. Please include that. Not normal deferred tax assets, only if they are unrecognized. So just to reiterate, what's the point here? I want to go from tax at normal rates, and I need to work out all the reconciling items and show the user why my total tax expense recorded is different to the tax at the standard rate. Okay. Now you can do this in two ways. I'm going to recommend that you do this in terms of the actual currency units. Okay. Work it out in numbers. And then take your effective tax rate, which is my actual tax expense, okay, and divide it by my profit before tax. And you'll get a percentage. And I can bet you top dollar that will probably not equal 28%. As a user of financial statements, I want to know why the tax is not exactly 28% of PBT. Okay. It helps me understand the future cash flows, helps me understand if we're making profits because of tax benefits or tax planning, okay, that may reverse out in the future, etc. Okay. So, just before we go on to the statement of financial position, I would like to quickly have a look at other comprehensive income. Okay, so just adding a page in here quickly. And remember, profit before tax, okay, is a profit and loss item. Therefore, the tax expense relating to that will also be a profit and loss item. But now below my net profit, I have to go and calculate other comprehensive income. And other comprehensive income is items such as PPE or property, plant and equipment gains, or actuarial gains or losses on defined benefit plans, etc. Those items do not go through profit and loss, and therefore the tax effect does not go through profit and loss. What I do want you to do is think about the following. If OCI is made up of a gain on PPE, okay, what I want you to do is have the gross effect disclosed, and then take off the tax effect. And show the net amount. That net amount will then go off to my statement of changes in equity. Okay. What are we worried about here? The tax effect must be shown separately from the gross effect. This is not profit and loss. This tax effect is in the actual item of OCI. Okay, I hope that makes some sense. Now jumping back into my disclosure template here, let's have a look at the second separate note, and here we're talking about deferred tax balance, okay? And I like to call this analysis of deferred tax balance. Sometimes there's other names, just people will just write deferred tax balance, that's okay, or they say analysis of temporary differences, that's also okay. This disclosure now, again, you don't have to do exactly what I'm doing in order to be compliant with IAS 12, but this format is compliant with IAS 12. Please be consistent and understand whatever approach you are looking to use, but make sure it's consistent. Okay, so we're going to start off first, and I want you to first have an understanding that I'm going to split up my deferred tax balances from temporary differences, normal temporary differences, from deferred tax arising from assessed losses. Okay, so let's start off. I would like you to split up, if you can, the taxable temporary differences from the deductible temporary differences. Okay, is that a requirement? You don't have to do that. You can combine them all under temporary differences, especially under exam conditions. It might save you some time, but for now, let's do it in a very well laid out manner for your understanding. So I've listed a few of them. This is not by any means a comprehensive list. So I've got property, plant and equipment, and prepaid expenses and financial instruments. Sometimes these may be deductible temporary differences. I'm just assuming that here they are taxable because that's more often than not the case. Now, where most people go is they just work out the total deferred tax liability, okay, for these taxable temporary differences. What I'm going to ask you to do is I'm going to ask you to have another column, okay, splitting out deferred tax that is calculated at normal rates versus deferred tax calculated at CGT rates. So PPE, if it's on the cost model and depreciation is different to wear and tear, that will only give rise to deferred tax at normal rates. But if there's a fair value adjustment above cost and the asset is going to be held for sale, then there may be capital gains tax rates. Okay? Again, we'll come to that later on. Just understand I want those two columns for good reason. Okay? Deductible temporary differences, which give rise to deferred tax assets. Here I've just listed provisions and deferred income or income received in advance. Again, you don't have to show positives and negatives, but I definitely want you to write assets and liabilities. Okay, this asset and liability description is very important, okay, because sometimes in questions or in real life in working papers, people don't always make debits positive and credits negative like I have over here. Sometimes it's the other way around, etc. Understand what are assets and liabilities. Don't try and learn positives and negatives here. So once you've listed all your taxable and deductible temporary differences, I want you to add up and get your deferred tax balance on temporary differences. Understand that if that is an asset, okay, then you need to ask yourself, is it probable that the future benefits will actually be received, i.e. will there be the future tax deductions? If it's probable, then yes, okay, you won't have to derecognize. But if it's not, then you may not meet the recognition criteria for assets. So there may be a deductible temporary difference that is not recognized. Again, a more complex topic for a future lecture, but understand that something along these lines may arise. Then the next one is to have a look at your unused assessed losses. Okay. Now, in simple terms, you will have your total tax loss carried forward. That will come from your tax computation. Again, that is in our next lecture. We'll show you how the tax comp is laid out and works. But that will give rise to a deferred tax asset. Conceptually, an unused tax loss that is recognized this year for tax purposes, well, it's a future benefit. As I mentioned earlier, how do the tax authorities work? If you have a loss in the current year, they don't give you a taxable or tax income. They don't give you the cash back. Okay? What they do is they say take those losses and offset it against future taxable income. So it's a future tax deduction, a future benefit, which is an asset. Now again, not all of those assets will meet the recognition criteria. Sometimes you may have to derecognize or unrecognize a portion of those assets, and you will land up with either a total deferred tax asset or zero for your unused tax loss asset. The same thinking for unused capital losses. Carry your full capital loss forward, recognize it, and then if you have to unrecognize a portion of it, do so, show the net effect on top as either a deferred tax asset or zero. And then last, you add up your deferred tax on temporary differences, your assessed losses, your capital losses, and any potential unrecognized deferred tax assets taken into account to get your total deferred tax asset or liability. Now, there's some discussion about whether those things should be offset or not on the face of the balance sheet. Okay, we'll look at that later on. But basically, if you have a legal right and intend to offset the two, okay, then you can show them as one net amount. If not, you may need to split out one or two assets or liabilities from the rest. Now, I hope this has helped. Please, this lecture was not intended to be an all-encompassing principle-based lecture. What I do want out of this lecture is for you to have an understanding of what the end result is, the disclosures for the income tax expense and the deferred tax balance. Okay, and I need you to learn these. If I wake you up at 2 o'clock in the morning, okay, dazed and half asleep, you must be able to write these down. If you cannot do that, you will not get through exams and you will not be functional in practice. Please, this is urgent. Download these slides, learn them, and make sure you know them off by heart before you do any further lectures. Thank you.